All right, we are live now. We will wait few more minutes to let other people joining in. And we have, okay, we have 7 people. Okay, 8. Okay, more and more people are coming in. That's great. Awesome. Okay, so let, hey, beautiful audience, welcome to another super interesting workshop. Thanks everyone for joining. Let us know the region you belongs to in the chats. I am Aryan, one of the guild leader of Education Guild of AlchemistDAO. You guys have probably seen me all over Discord, Telegram. I'm just everywhere. So this workshop will based on tax implication for cryptocurrency transaction and other related parameters like NFT, DeFi swaps and loans, ICOs, investment, and business accepting payments in the form of cryptocurrencies. So basically, you will get a broad understanding how to kickstart with basic tax guidance. If you have any question, then feel free to ask in Q&A session. So we have Abhinav, who is a cryptocurrency expert and is presently a cryptocurrency tax accountant at California-based CPA public accounting firm, where he assists client with investment portfolio ranging from $10,000 to $2 billion. So Abhinav also assists India-based crypto investor with cryptocurrency taxes. He has over 4 years of experience in assisting international investors across geography with cryptocurrency tax calculations and crypto investment management. He has earned his MBA in finance and accounting and also a master in commerce along with a professional certification in financial modeling and business valuation. He has in-depth expertise in the field of finance and crypto accounting. He is a regular content contributor at Pocket Expert Solution, offering his expertise to crypto enthusiasts and investors. So Abhinav also been a speaker at global summits at the panelists to discuss the growth and scalability of cryptocurrencies and blockchain. So yeah, that's all about Abhinav. So yeah, without any further delay, I would like to hand over this to Abhinav.
Thanks a lot for the introduction, Aryan. I'm going to share my screen real quick so we can dive into the
Yeah,
presentation.
yeah, sure.
Okay, so this session, as it was mentioned by Aryan, is basically about cryptocurrency tax implications, not just in terms of investing or buying and selling coins, but we'll also cover a lot of other aspects like ICOs, businesses that need to accept them as payments, and DeFi transactions and stuff like that. So I'll move on to my first slide. First one is about introduction to cryptocurrency taxes. Now, there's a common question for all investors that what triggers a taxable event. Now, to keep it basic, a taxable event essentially occurs when you're selling a coin. That's when essentially you make money. A taxable event also occurs when you trade one coin for another. Now, this is something that not many investors are aware about. Investors feel that when they have Bitcoin and they are trading it for Ethereum, it's not a taxable event, which is incorrect. That is a taxable event because essentially you bought Bitcoin at a lower price, you sell it at a higher price, that generates taxable gain or loss. So that is a second taxable event. Now we're moving on to airdrops. That's when you get airdrops from, for example, a company, or there's a hard fork that happens within a coin, and then you get airdrops in place of that. So that's a taxable event. Staking income is another way of generating taxable income. Staking essentially is when you have certain number of coins and you give it to a platform, and then that platform holds it as collateral for a certain period and then gives you interest along with your collateral held amount. Interest income generated using DeFi products is another taxable event. DeFi products, what I'm talking about here is DeFi loans and swaps. DeFi loans is when you again you keep collateral with a company, and then they give you a certain number of stable coins in place of that, so you can trade further and generate revenue for yourself. This is not exactly a taxable event for you. So, for example, if I have Ethereum coins and I keep it as DeFi for a loan to a product, that's not me selling the coin. I'm just keeping it as collateral. And then the USDT, for example, if I get it as a stable coin, I trade it and I earn some interest on top of it. That part of that interest is my taxable amount here. So that's something about what triggers a taxable event. Now, types of transactions again include buying, selling, there's withdrawing coins from one place to the other, you're depositing coins from one platform to the other, there's lending, as I mentioned about DeFi lending, then there's staking and ICO investments. There's the types of calculation methods that everyone is using across. That's first in first out, last in first out, and highest in first out. First in first out is basically, it's like inventory management. So when you purchase something, for example, I purchase a Bitcoin in the month of Jan, and I buy another Bitcoin in the month of April. So the first in first out method allows me to use the one I purchased in Jan and use that cost basis towards the selling price to get my taxable gain or loss. And moving on to the second method, that is the last in first out, keeping the same example. Now, if I use the last in first out, I will essentially use the Bitcoin purchased in April and use the cost basis of that towards the selling price and then calculate my gain or losses accordingly. Now, coming to the highest in first out, this is the most interesting calculation method according to me, and I feel it's the most efficient one as well, because it's different in cost basis. For example, the Bitcoin I bought in the month of Jan, I bought it when Bitcoin was at $20,000. And in the month of April, Bitcoin went up to $40,000. So if I happen to sell Bitcoin, before the year end, before the taxable year ends, if I take the HIFO method, that's the highest in first out, and I take the one that is the highest cost basis, it reduces my taxable gains for that year. Now, keep in mind that we are not, there's no, this is not a loophole or this is not going around the system. You're just delaying your taxes. But yes, clients do benefit from it because it does make a difference when you're filing for your short-term and long-term capital gains. So that's one of the most efficient method according to me. It is very important for investors to track their transfers and cost basis. Now, this is extremely important, and every investor needs to make sure of this because, for example, if I start investing in 2013, I bought Bitcoin when it was at, I'm using Bitcoin because it's more of a common term and more viewers might connect with it more because it's currently the most, famous one, I would say. So if I started investing in 2013 and I bought Bitcoin when it was $200 to $300 and I just held it, and cut to it goes into 2022 or 2020. Now, if I sell in 2020, I'm transferring it from Coinbase to Binance to another wallet, and another wallet to again Coinbase to sell it. So according to the exchange, when we are exporting these reports, they do record these deposits, but the exchange doesn't really know what you did with it and when you actually purchased it. So on the export, you might see on the Excel that the exchange gives you, you can essentially see that, okay, fine, there is a deposit made, and that becomes your cost basis, which is not the fact. So this might lead to misreporting in your taxes. That's not the right way to deal with it. So tracking cost basis while transferring coins from one place to the other is the most important aspect, I would say, in terms of taxes. There are a lot of software that do these calculations as well, but again, software provide you with a summary report when you link all your transactions. So when you get a summary report from the software, I'm not going against any tax software here, but this is just to explain basics about when you are using a tax software, what you should be aware about. In the event of a tax audit, now, for example, if you're hit with a tax audit notice, now you cannot show the auditor or the tax government agency of a summary report and say that, okay, this is what I have and that's how much I owe. If they've sent you a notice, they need further explanations that goes step by step, which software does not support. Like, they're not going to show you the actual calculation algorithm behind their software for you to support your tax audit. So that's one of the reasons why manual calculations might be a good way, although it is very time consuming and it might not make sense for a day trader because it'll just take a lot of time. But again, transfers, I'm emphasizing on this because it's really heavy for all investors to pay attention to. Even if you're using a software, you will link your APIs to the software. For example, if Coinbase is linked, they will still feel that the deposit date is made on the day you deposit the coin. But if you've transferred it from one wallet to the other, purchased it in 2009 or 2010, Coinbase doesn't know when you bought it. They just know when you deposited it and when you're selling it. So this is kind of a gray area that needs to be kept in mind by all investors when they're investing. Another thing is that DeFi loans. Now, I've also personally used a lot of these tax softwares, and most of them, when you are trading with DeFi loans, what happens is you're essentially giving your coins to that company as collateral. Now, tax software also sometimes, treat this as a taxable event. In real, you're not actually selling any coins. You're just sending it to that platform to hold as collateral. But when you're exporting a transaction report summary from a tax software, it shows it, sometimes as a sell order that was generated. This might be a software glitch, but these are things that investors need to make sure of. And even all these software, when they take care of things, they have a non-disclosure that they have certain responsibility to, provide customers with a report, but they don't take complete liability on things. Staking is another issue that I have seen personally. When you stake coins, it's the same issue. Like, you're depositing coins somewhere else and you're not selling it. So this is something that software need to build upon. And the main issue, according to me, would be for software is classifying what kind of a transaction it is. How to make trading tax efficient. Firstly, I would say that tracking records. So a lot of exchanges tend to lose the data of clients. So getting into the exchange, exporting your files every 3 months would be the best way to make sure that you at least have your data ready for yourself. So if there's a tax audit, you at least have some information to share with them. Another thing that you can do for making it efficient is using the best calculation method. As I mentioned, that HIFO, according to me, is the best method and the most tax efficient method in those terms for clients. Yes, again, using software might not be the best solution to it, but doing things manually, having a professional do it for you, makes a big difference. um, I'll move on to crypto tax audits. Now, crypto tax audits are not that common yet. But I personally have attended an audit and led one for one of the clients. It is quite tedious, and the agents really, the government agents need to know everything. So they would look for bank statements. They would look for your whatever exchanges you're trading on. For example, they might ask for your login credentials for example, Coinbase, Binance. They might, they would like to tally some of the transactions using your calculation methods. So there's a lot of in-depth research that goes around to actually clear the audit. It's not that the auditor comes in and you give him a tax report summary from a software and it's done. It wouldn't be as clear as it is, especially if you're trading, hundreds of trades a day. So that's something that, according to me, would be a really complex process that would be solved probably by something manual, or else there is a software in place that actually takes care of all these parameters like transfers and ICO purchases and DeFi products and stuff like that. Wrapping up the first slide, I would like to pull up a poll. Let's see what I would like to know from our viewers as to how many of them either investing or what's the status of I just need to understand how many of our attendees are actually invested in cryptocurrencies, or how many are getting into it, trying to invest, don't know much about it, holding back, thinking the tax implications might be complex, things like that. Okay, that's good. We have it's good to see most of you guys are just holding the coins, because essentially that's the best tax efficient way. Just hold it till you can see the company perform.
We also have traders.
Yeah, there's a lot of traders. I hope all
Mhm.
traders are listening to all our conversations today, so they can keep their tax space covered up. Planning to start investing one. Okay, that's a good sign. I think this session would give a lot of information about what exactly is needed, how to start investing. ICOs are a good way to start investing, but there's a lot of research that needs to be done before you invest in an ICO. So I'll talk about that a little later in the session today. Okay. Okay, that's good. So overall, I would say that 61% of our attendees are just holding. That's a good sign. It's just a question, which coins are they holding now, and since when are they holding? I think I'm going to end the poll so we can. Okay, we're still getting a few selections here.
You can minimize that.
Okay.
Yeah.
Should we take it to the next slide?
Yeah, sure.
Okay, so taxes, staking, and DeFi. Now, staking and DeFi is kind of advanced models in the world of cryptocurrency, and taxes for that, no doubtedly, would be even more complex. So before I get into that, let's start with the first point, that is proof of stake and proof of work. Now, proof of stake essentially is some owners of a particular coin would stake their coins, or for example, if you have 10 ethereums, you would give those 10 ethereums to a platform, and that platform would hold those coins as collateral for a certain lock-in period. And once that's wrapped up, you would get a certain APR interest in the form of coins. So if I have 10 ethereums that I'm staking, at the end of a particular year, I would get 11 ethereums or maybe 12. That this percentage ranges from different platforms. So this depends on which platform are you trading or doing DeFi transactions or staking coins. Um, how are these interests even generated? So first is network fees. This is when a blockchain or when a platform generates network fees, they issue certain amounts towards the interest that's given to customers or users that are actually staking these coins. Another part is newly mined coins and reward mechanisms from these coin companies or these platforms that are actually supporting staking. um, so this is totally different from proof of work. Proof of work essentially is when there are a group of miners or mining, or one miner that is trying to create a coin. There's a lot of algorithm, and when a successful block is mined and accepted by the owners of the blockchain or the current players in the blockchain, that's when the proof of work is completed, and that miner is rewarded in the form of coins. So essentially, you can look at it in this way, that these both aspects are supporting the blockchain and supporting the company's coins, but it's totally different. In one, you're just giving some coins that you actually own. In the other, you're helping the company grow by participating in the generation of these coins. um, Staking rewards versus bank interest rates. Staking rewards, in my opinion, are one of the best tool of in the world of cryptocurrencies. It's much better than, in my opinion, is much better than bank interest rates for many reasons. It's the same way as I mentioned before. Staking rewards, you just stake a few coins and you will get interest rewards on that. Now, the main difference between staking rewards and bank interest rates is percentage. There's a few coins that I listed down here for everyone to know. That's NU, there's Rose, there's Casper, there's Mina. All these coins are giving an APR of about 20 to 25%. And when you compare this with bank interest rates across the world, now I've listed a few countries as well. There's the US gives 0.01%, India gives 5%, Australia is giving 0.25%, the UK gives 0.24%, Germany gives 0.02%, and Spain gives 0.01%. It's a simple choice. You either stake your coins, you keep your money with cryptocurrencies, stake those, and you earn this kind of an interest reward on it, or you actually keep your cash in the bank, which is it's obviously not going to increase so much. Inflation will defeat this kind of a percentage rise in your actual cash holding. And it's a clear choice here, according to me. Again, I'm not going anywhere against banks and financial institutions, but this is a choice that now investors can make. um, if you go to see, yes, banks are safer. The value of money that is kept in the bank will not depreciate or will not go down in a way. But when you look at staking rewards, it does come with a few pros and cons. That's So when you look at it, if you're staking coins, if I have 100 ethereums, and if I stake those 100 ethereums, and at the end of the year I have a lock-in of 1 year, and at the end of the year the value of ethereum goes down from $4,000 to $400. So I would, if I was not staking it, I could just sell them and cash out before the market would crash. But because I'm staking those coins, there's a lock-in period. I cannot even pull that out that easily. So that is one drawback that I would say. But if you find a nice company, cryptocurrency would not just depend on Bitcoin and Ethereum. There are many companies out there that are doing brilliant work. They're solving real life issues and issuing coins. The whole point of this is, they're just raising funds to solve real life problems. So if you find a nice company, you see they're doing staking rewards, you can purchase a chunk of it and just take it. That's the best way I would consider this as an opportunity. Platforms available for staking in today's time, all platforms offer staking rewards. Like, for example, you can stake coins on Binance, you can stake coins on OKX, you can stake coins on each and every exchange out there that supports crypto trading. So it's not that we have to go to a certain platform and just stake over there. We have so many options, and investors have that option to choose the best platform. So if they feel that one platform is giving them 10% but the other one's giving them 20%, it's their choice. Now if you go to see, OKX has a feature called flash deals. You open that feature and you get several deals that give 125%, 200%. There's many options available for investors to actually get money out of their money that's held. Taxes on staking rewards is a very interesting topic again that I would enlighten on. So when you get staking rewards, that is treated as ordinary income the minute you get it. So for example, if you stake 10 Ethereum, you get 1 Ethereum as the reward. So now you have 11 Ethereums. But that 1 Ethereum will be considered as an ordinary income for your taxes, because you essentially didn't have a cost basis to it. You didn't pay anything to get it. So that's your ordinary income. You keep track of the date when you received it and the price of Ethereum when you actually deposited those coins. Now this is important because this justifies to your cost basis of the coin. So if I got a deposit from the platform of that 1 Ethereum as a staking reward, and today Ethereum is at 4,000, so that's my cost basis. If I decide to sell Ethereum next year and Ethereum reaches $10,000, $6,000 would be my capital gain. So it's a dual tax system for staking rewards. There's a lot of risks versus rewards, as I mentioned before, and I did talk about one of the biggest drawback for staking, and rewards are endless. I mean, you can clearly make a higher percentage, and there are also many products that offer these staking rewards for a shorter period. So it's not that I have to stake it for 1 year. There are many other platforms that let you stake for 7 days. So you just stake for 7 days. That's your only risk involved. You do get 120 to 200% APR that's divided by 7 days, and that's the interest that you get depending on the quantity of coins that you're actually holding with the exchange or the platform. So DeFi loans and tax implications. DeFi loans are, is another excellent platform, a tool that I feel it's there in the cryptocurrency space. So it essentially lets you lend or borrow coins from it's like P2P, person to person. So this also works very well, because if I have 100 Ethereums and I would like to just lend it to someone else because I'm not going to sell it, so I get a higher percentage and I can give it at my cost what I feel would be the best benefit for me and for the lock-in period that I decide. Tax implications, again, I'm just lending those coins, I'm not selling them, and the interest that I generate on those coins will be my taxable gain. So it's not that I'm generating the dual taxes here. It's just one event that occurs, that's the interest that I get. Keeping a track of these things are very crucial. So if I know I have 100 Ethereums, and when I get the coins back, I know that I got say 10 Ethereums more. Or if I got it in a different currency, if I got say 5,000 USDT additional to my 100 Ethereum, so that needs to be kept a good track on this. All these keeping a track of these things will just help safeguard investors during a tax audit. And believe me, when there's a tax audit, the auditors need to know everything. They dig deep in and they go through all your wallets. If you're subpoenaed, if it's an in-depth analysis, then everything is in the open. And most importantly, blockchain, the whole concept of blockchain is that all the information is openly available to anyone. So this is something that should be kept transparent, and there's no way to go around the system, and no one should. That's the whole point about cryptocurrencies. Again, DeFi swaps and tax implications. DeFi swaps work similar to DeFi loans, I would say. Over here, what happens essentially is that you're just swapping the coin. Now, if I have 100 Yearn Finance coins, that's a YFI coin, and I give it to a platform and I get, say, for example, ZYFI. That's a similar coin that's just named by the platform, and that's equally pegged with Yearn Finance. There is a lock-in involved here, and I do have, and the exchange essentially would give me, say, 20 Yearn Finance additional. And when the term ends, I have to just go back to the platform, return the ZYFI to them, and I get back my YFI coins. Tax implications, again, it's just those 20 extra YFI coins that I receive will be taxed as ordinary income. And again, dual tax, because that becomes my cost basis, and from there will be the taxable gain or loss depending on when I sell it. um, tracking staking rewards and DeFi revenue. Tracking these transactions is extremely important. Again, everything is important here, right? But keeping your data with you and you having enough information for yourself of what you do is the most crucial moment here. There are a lot of platforms that do support DeFi and staking reward tracking. One of them is, Zerion, that's powered by Covalent. So that's one of the best platforms that I've come across that helps tracking DeFi transactions. So you get to know that, okay, this transaction was a DeFi transaction, it wasn't a sell trade. So like this, you can keep a track of all your transactions very accurately. However, Zerion and all these platforms do not really support everything in one place yet. In my opinion, I'm not too sure how in depth it is, but a software that integrates all exchanges and all wallets is a one-stop solution to cryptocurrency taxes. Um, let's get some audience poll again. Let's get engagement, because I want to know about how many of our viewers are actually involved in DeFi or are actually even looking ahead with it. Let me end the previous poll. Okay, we have our next poll live, and we'll just learn some about who's taking coins. Are there any DeFi loans going on, swaps? Not sure what this is, because I'm sure most investors don't really know about these things. They're just investing money, buying coins, selling coins. So DeFi and staking would be something that's more advanced. Okay, that's great. I thought that a few of our attendees might not be sure about what exactly this is. It's good that we're having the session, so even if anyone has any questions, we can answer them at the end of the session, because getting things cleared out is most beneficial for investors itself, because they can really get themselves involved with these products that are giving such great returns. So you don't need to just invest and find the exact exit point and get some capital gain or loss, again worry about the taxes. Quite a few of them staking coins, which is good. The staking coins, in my opinion, is one of the best feature that cryptocurrency ever invent or has. You can get amazing returns, and you don't have to stick to one coin. You just buy a bunch of those coins that are giving a good APR, look for the best deal, get through the staking rewards for a week or 2 weeks, cash out, and you can move on to the next product that's available for staking. This is a feature that I've noticed in an exchange called OKX. They have these flash deals that goes on, and you can just take for 7 days, for a month, for 2 months, get a great APR on it, and then just cash out and move on to the next coin. I'll leave that poll open, and we'll get back to that once we're done with this slide. Taxes for businesses accepting cryptocurrencies as payments. There's a lot of businesses out there that want to accept cryptocurrencies as payments, especially because it is the thing, right? Every company and every individual wants to get associated with cryptocurrency in some way, and accepting it as payments is probably one of the best ways, that one of the most used cases. That's the reason why Bitcoin was also created, to use it for payments and not to depend on financial institutions for everything. So I'll first start with the government approval and legal status. The first thing that business owners that need to take care of is, does the government approve it in your country? That's the first thing. Second, what is the legal status of cryptocurrency? Because a few countries treat it as an asset, a few treat it as stock, a few countries have it as taxable, a few don't. So that's the a few countries don't even have any legal guidelines or tax guidelines as yet. Like India doesn't have tax guidelines so far on cryptocurrency trading. And there's a lot of investments that's gone out of this country, and huge potential. I see huge potential in India also in the crypto space. but getting clarity on simple grounds in terms of what is the legal status of cryptocurrency in the country, how will it be taxed. That is something that's most important. Low transaction fee is a feature of cryptocurrencies. Now there are so many blockchains out there that offer, you know, transactions at at low fees. So for example, if you're just sending some coins to one wallet to the other, the transaction fees vary from blockchain to blockchain. Now for example, I recently used the Tron blockchain, and the fee was, it shocked me, it was almost zero for transferring coins from one place to the other. So that is, so this depends on, which platform are you using, what coin are you trading in. Ethereum has a high transaction fee. That was in the news a few months ago. Gas fees were extremely high for all transfers, but that's not what is the limit now. There's many options available today, and it's up to the investor what platform does he or she need to use, what blockchain to use, whether all platforms are offering that or not. It's an open space. um, Instant transfers is one of the second most important feature. Now when, let's look at it in this way: when businesses are working with banking institutions, every time you make a transaction, every time a customer comes in, there is a fee charged by the bank to process that transaction. Then if, for example, if I have a vendor, I need to make a payment, I have to first add that vendor as a payee. It takes about a few hours or a few days in some countries. And then I have to actually, set up the payment system, add the information, go through KYC. I need, if the amount exceeds $10,000 or $100,000, it needs prior approval for the payment. International payments take T+2 days, and it's just a lot of systematic things that are set up, which is good. But in a way, it's also a drawback, I see it. Because if tomorrow I need to order goods from another country, I the vendor does not need to wait for 3 days. And if I make the payment to my vendor in 3 days or 4 days, I would receive the goods next week or probably in the next 2 weeks, which is not required. That's one of the major advantages of cryptocurrency, that it does instant transfers. Now if I have a deal with my vendor and I would like to purchase some goods, I just open up my wallet and decide to transfer 2 bitcoins for the goods that I'm receiving. And believe it or not, the vendor is going to receive all the coins within a few minutes. And again, transaction fee might, come into everyone's thought that, okay, no, but I'm paying a high transaction fee to transfer coins. There's more than 10,000 different cryptocurrencies, and not all of them have the same transaction fee involved. So you choose the best currency for you, see which one's taking the minimum fee, and just do the transfer. That's how easy it is. So if I have a business, I need to setting up a wallet for payment systems for my customers. Again, it's a very easy process. You deal with either you work with an on-chain wallet like MetaMask, or you have any other independent wallet. MetaMask doesn't even need KYC, and you can just go through it, create a new wallet or token wallet. You open up scan the code, save the code for yourself. You have a barcode given to you. You can just use it at your store or online. Customers can scan it and pay you money within, the coins get transferred within a few minutes. That's how instant it is. And the best part here is there's no financial institution involved. So every transaction is, essentially P2P. You're dealing with the customer directly. There's no bank involved, and there's no fees going to them. And especially for international transactions, there's forex involved, right? Currency fluctuations and many things like that. Like the bank, if the dollar rate against a particular currency today is 77, but the bank would give you a rate of 72, so you lose money immediately when you decide to make the transaction. So those costs are hidden costs by financial institutions. So I just spoke about setting up a crypto wallet. If you look at any exchange like a Coinbase, Binance, and again OKX, Crypto.com, you do your KYC there, register as a business or whatever name you would like to do it with, and you get a wallet for your coin. And the same process, you keep your barcode with you. You have a wallet address. You can use that easily to make payments or receive payments. Now there is a point to be made about price volatility here. The prices are going to fluctuate. Now, El Salvador made Bitcoin, nationwide legal. There was an argument that small businesses might not be able to cope up with the price volatility of Bitcoin. Today, Bitcoin is $62,000. Tomorrow, it might go to $30,000. So, what about the small vendors or small, business owners that cannot bear this fluctuation? Essentially, whatever goods they sold yesterday would drop half by value the next day. So that would be a big loss for them. MNCs do not worry much about price volatility. Like if Starbucks tomorrow starts accepting Bitcoin, they won't really get a pushback on price volatility much because it's an MNC, right? It's all over the world, so the effect and impact on them might not be as heavy as smaller businesses. But you have to look at it in this way. I mean, money is never going to increase in value by itself. Inflation is going to come in and the value would always keep going down. But in place of crypto, there is a possibility of it going up in value. This possibility plays a very important role because this is not possible in regular currency transactions. So this is an advantage in my opinion. Customer frauds is something that it's quite common. Now, for example, if I have a business and a customer purchased goods or services from me, and then next day I get a notification from my bank saying that, oh hey, they just called in saying that it was a fraud transaction and we've refunded them the money and we've held your transactions in place of that. It's not fair for business owners if in such situations, because there's the benefit of doubt is given to customers in this case when there's a trade exchange of goods or services. So this is something that is solved with cryptocurrencies because transactions are irreversible. So once you've sent any currency to another wallet, you can't cancel the transaction as such, or you cannot really reverse that transaction. If it's sent, it's sent. So this takes care of customer fraud. If goods or services are exchanged, that's about it. The payment has already been made. This might be a drawback for customers because they've already made the payment. Even if the goods come in damaged, you cannot reverse it. That's I'm talking both sides. A taxation here plays an important role because when businesses are accepting coins as payments, there's again a dual tax system that needs to be maintained. First is to to choose the right calculation method. Again, if you choose the HIFO method, that's advisable by me. That's the best for individual traders, businesses, day traders, everything. HIFO is the best way to deal with it. Tracking cost basis is also equally important, and if you have to report a taxable gain or loss on that transaction. Now, for example, if I do receive, there's a sales revenue generated of goods. That's so when I sell the goods, that's sales revenue. I received 100 Ethereum for that. Now, if I decide to hold that 100 Ethereum for 2 months and the value of it goes up by $2,000, that $2,000 becomes my taxable gain or loss. So in the books of a company, it might be displayed as revenue generated from other streams of income or revenue generated from fluctuations in currencies, things like that. Bookkeeping is also a little bit complex when it comes to cryptocurrencies because it's not cash that's being received for goods. It's an asset account. You have to create separate asset accounts for different coins that you receive, maintain that inventory in such a way that you are matching it with the calculation method or the HIFO method, FIFO method, LIFO method, whatever method is being applied. You have to match it with the bookkeeping procedures as well. Now, in bookkeeping, you have to track the invoice amount with the value of goods that were actually sold, because at the end of the year you have to sit and do your books. You have to know, okay, fine, this invoice was issued, we received this much Ethereum against that invoice, and now the value of Ethereum is X amount, that is higher than what we sold goods for, so this becomes our taxable gain or loss. So bookkeeping and taxation go hand in hand when it goes to businesses accepting cryptocurrency as payments. Let me real quick open the poll again. Let's see how our previous one did. Okay, so there's a lot of our attendees into DeFi swaps. That's good. Staking coins is also 13 out of 50 people are staking. That's good. I'm going to end this poll now, and I'll move on to my third poll that is prepared, for businesses. Let's hear how many businesses or business owners are actually accepting coins right now, or planning to accept. You're really confused about the process. You need to know more about the tax aspect of it. You're not too sure how to do the accounting for it. Let's see how the response is for this. There's a lot of yes. I'm happy to see that. It seems to be very complex. I think after this session, I hope I'm able to solve a few doubts for the people who feel it's a complex process and help streamline that for them, or anything that would take for that. Okay. Even planning to accept is a good step. Like you're getting closer to getting adapted to something new. Because according to me, down the line, from a year, 2 years down the line, most businesses will just accept cryptocurrencies, and it's going to be treated as a regular transaction. It's going to be a normal thing, the new normal, as everyone calls it. So the sooner the better, because when competition comes in, there's when you open doors to cryptocurrency payments, it allows customers that even don't want to buy something, but they have cryptocurrency and they go like, okay, yeah, let's try it out. I might as well just send like zero point 0.5 ethereum and check it out what it is. That's exactly kind of what's happening with the NFT world. Most NFTs are bought and sold using ethereum, most of them. So if even if I have 100 ethereum, I don't mind giving a point 0.2 ethereum buying some NFT. Okay, a lot of businesses accepting it, which is good. Let's chat more once we're done with the session. So this is my last slide for today, and this is also an equally interesting part of cryptocurrencies. That's tax implications on investing with ICOs and receiving airdrops. Now, investing in an ICO, this is something that new investors or people who don't have much knowledge about investing in cryptocurrencies might want to explore. Now, when I think about cryptocurrencies, I think about Bitcoin, Ethereum. I just sign up on some exchange and do my KYC and buy those coins. But there's an entire different world that needs to be explored by investors. Now, I'll start with what is an ICO. Initial coin offering is done by companies that are solving real life problems, that are doing amazing jobs, that are doing something that's going to solve a problem that exists in the real world, and mostly using technology, artificial intelligence, and they have a roadmap, they have a game plan in place, and they're just looking for funding. So it's similar to IPOs. That's initial public offerings. They're just raising funds in a different way. For an IPO, you need to go through government regulations and many other steps like that. But for an ICO, it's open to another world. So for an IPO, it's country restricted mostly. But for ICOs, if I go for an ICO funding, I'm funding is available around the world. So I'm not restricted to one country here. So the amount of capital that can be raised in an ICO is unreal, because I have no barriers here to one country or the other. I'm available to each and every country depending on the type of ICO, where is the registration done, where is the company incorporated, and things like that. But getting invested with ICOs needs a lot of research, and before investing into ICOs, a lot of steps needs to be covered by every investor. Now, first thing that affects an ICO, I would say, and the research elements include, is market news. Now, if I hear about a coin that is, in the news and they're doing a good job, I would essentially just look up to a few market reviews as to what the coin does. I would look up a few Twitter handles of personalities, or the company's Twitter handle, and see what they have to share about themselves and what are the company updates. I would refer to the company website. I would also refer to the white paper. White paper, I call it as the Bible of the company, because everything about a company is present on the white paper that is openly available to everyone. It's not that if I'm the investor only I can see the white paper. That's not the case. Each and everyone can see any white paper of any ICO by just clicking a button, and you get access to all their data, what they're up to, what the roadmap is. Also, another thing to look after is what is the team behind the ICO? Who are the key players involved behind it? Who has backed the ICO? If early backers involve companies like there's venture capitalists in, there's Coinbase, Hash, all these companies are supporting it, that means there's already a research done by them and it is a trusted company, and it might be a good potential ICO. We can look at other things like what is the maximum supply of the coin, what would be the circulation of supply, how many coins will be issued to the team members, what would be the coin that would be kept as treasury, coin quantity treasury for the company that would not be issued otherwise, which blockchain are they using, what's the roadmap as to what are they trying to do and in what time frame, and also just about the product, what they're trying to do. So if it is a company that is trying to solve a technical problem, how exactly are they solving the problem? Everything is available on the internet. It's just that every investor needs to go out there and search for it. I'm also going to give a few steps as to how exactly you can do this search. Um, which is my next discussion. That's information about upcoming and active ICOs. One of the most interesting platforms that I came across was ICO Drops. This platform gives you information about what are the upcoming ICOs, which ICOs are actively running, which are the ended ICOs, and they also have their rating system given that includes interest level, hype level, ROI level, and risk level. So they have their team, private team, that does all this investigation, and according to them, is it a high rated ICO or not? But again, investors don't need to rely on this, they need to do their own research, but this is just another parameter that they can put in consideration before investing. um, Factors affecting the ICO performance. Now, there's a lot of factors that can affect a performance. It's not just an ICO. It's like a regular company, right? There, every company sets up a management team. They set a roadmap. They execute their plans. They take care of competition. They do have blockchain support. They have a tech team doing their work. They have a marketing team. They're doing their work. So it's like a regular business. Some businesses flourish, some don't. So it totally depends upon all these parameters as to how they reach their goals, how they reach out to the public, what is the acceptance from people, and how people are adapting to that company. Now, if there's a company that's promising to solve a certain tax issue, for example, so is that company actually solving that issue down the line, 6 months down the line? That's how the company will get a response from people. um, so that's some. So for example, I came across another token the other day that's called Efinity. Now Efinity is created by the team of Engine. Now Efinity is basically it's for kind of for gaming and reducing the fees involved with NFTs and all of that stuff. Now if this actually happens, the demand for Efinity coin would go up. That's how easy it works. And also it depends upon demand and supply, basic economics. If the market circulation of a coin is 50 million, and they have a total max supply of 2 billion coins, so there's only 50 million coins available for users or investors to buy and sell. So there's limited supply, and if the demand crosses supply, it has to go, the price has to go up. It's that how it works. Now, sources of airdrops, I would say there are multiple sources of airdrops. That first of all, there's hard forks. Hard forks are also, I mentioned this at the start of our session today, but I'll explain it more. Hard fork is happens when a blockchain evolves, or there's more advancement done, and they feel that there are some changes or improvement that can be done. So for example, there was a Bitcoin hard fork that happened back in the day. Bitcoin Cash tokens were allotted to all investors who are holding Bitcoins. Ethereum also went through a hard fork. Ethereum Classic coins were distributed to all holders of Ethereum. So if I have 5,000 Ethereums today, and if there's a hard fork of Ethereum, Ethereum Class, I get 5,000 tokens of ETC as my reward. Talking about taxes on these airdrops, again, if I get 5,000 ETC coins as an airdrop through the hard fork, it's ordinary income because I didn't have any cost basis to it. And again, there's a dual tax system here. It'll be taxed again, or depending upon how long I hold it for and the price I sell it at. Taxation on ICOs. So let's take an example while I explain this. If I'm investing in an ICO, I decide to buy 5,000 tokens of a company X. Now I'll get 5,000 tokens. I spend $2,000 for that, for example. I get my 5,000 tokens. If there is a lock-in period, generally ICOs have a lock-in period when you invest in them on an initial stage. So typically they lock it in for about 6 months to 1 year, depending on the price option you go for. There are two options available for all ICOs. Either you buy at a high price and you get lesser lock-in, or you buy at a lower price and the lock-in is a little longer. So the minute you get that coin that is actively tradable in the market, your short-term capital or long-term capital gain decision starts from there. So it's not that, okay, my coins were locked for 1 year and now I'm long-term capital gain. That's not how it works. You didn't really do anything. You didn't hold it. It was locked and you couldn't trade it. So your the day begins on when you actually can trade it in the open market. That's when your day one begins, and from there, long-term and short-term capital gains are decided or calculated. Um, Taxation on airdrops, I already mentioned that while I was talking about sources of airdrops, so that's already cleared out. It's again dual taxed. As you receive the airdrop, it'll be taxed as ordinary income right over there, and whenever you decide to sell it, depending on your holding period, there will be a taxable gain or loss incurred. um, this is an interesting topic that we're ending it with, that is ICO frauds and company failures. Now, I would say company failures is not something that you can blame anyone for. The product didn't work, the technology didn't work, something went down in the management, people didn't like the product anymore, the demand fell. Many things can happen for a company failure. But when you look at ICO frauds, that is something that it's done intentionally, and most commonly it's known as exit scams. This happens when a coin company holds an ICO and they have a roadmap, they have a management team, everything is solid, the white paper is good. But once the fundraising is done, the investors don't receive any tokens, and then the coin company just vanishes. This is a reason why I recommend every investor to go through a detailed research of everything involved while investing in an ICO. As mentioned before, there are many things to look at, like you see who's behind the ICO, what problem they are solving, are they known people in the tech industry, how long have they been in this industry, and what is the supply of coins, who are the backers, because there has to be good backers to a good company. That's how the first round of VCs is processed. So these are things that investors can keep an eye on while investing with ICOs and receiving airdrops. I would like to end this session with a quick poll again. I don't want people to get bored with my polls, but it's really important to understand um, where do people stand in terms of. So let's look at our previous poll. Um, there's 23 out of 51 of them who are actually receiving cryptos as payments, which is good. 12 of them are not sure because the tax and implications might be complex. We more than happy to solve that at the end of the session through Q&A. Um, let's open up the last poll. That's the fourth one, and this is just to get an idea of who are investing in ICOs and who are receiving these hard forks and received airdrops from coin companies. Okay, this is another thing, like a lot of these ICO companies have these programs that are running that give you free tokens just to promote them. So you post something on Twitter, you post something on all your social media platforms, and you get certain number of tokens. That's a great way how you can just earn airdrops. Okay, there's a lot of people who are actually receiving airdrops from these companies. ICO investors, a few. It's kind of difficult to get an ICO. I would say I've personally tried getting a bunch of them, and mostly I'm just in the waiting queue. I'm in the line. There's 100,000 people ahead of me, and then the supply just ends. So that's how it does happen. But lucky ones do get it. That's all I would say. That's quite good because there's a lot of people who are receiving these airdrops from companies. It's kind of like free money. You help promote. It's like you're a freelancer to these companies as a marketing associate kind of a thing. You're just helping them grow their reach, and they pay you in tokens. There's just three people who received hard forks, which is that to receive a hard fork, you need to be an early investor. You need to get in when the coin was in the early stage, and then it actually does a hard fork. It's kind of like a stock split that happens in the IPO world and the stock industry. Where you hold certain stocks of a company, and then the company decides to do a stock split, and you get some amount of it depending on your current holding. Okay, Aryan, should we wait till everyone a few others join in this poll, or we move on to Q&A?
Uh, we can minimize the poll, and
Okay.
we can just answer some question in Q&As.
Okay, sure.
Yeah. So there are a few questions in Q&A.
Okay, let's do it.
Okay, so how would you treat a crypto grant receipt to develop a DApp? What are the tax implications? Is it better to accept the grant as an individual or into a corporate entity?
I feel it's always beneficial to receive all this as a corporate entity, because when you set up an entity, there's many advantages. You can just expense most of the things. Because if a company receives such payments in coins, there are many expenses that a company incurs on the same. But when an individual receives such grants, you have to pay your taxes based on the amount received. There's no work around that at all. So depending on your income slab, you will essentially have to pay either 40%, 30%, depending on which country you are from. So setting up an entity, not only for receiving these grants, but also for, if it's in high quantity, that's when you should set up this entity, because setting up an entity also is kind of a tedious process. I always recommend also NFT traders to set up entities for these things.
Okay, so we receive a second question from Sundar Dubey.
Okay.
Suppose we transact a privacy coin like Monero or Zcash, and then take it back with some more coin adding to it. Would this transaction be taxed with the whole quantity of token that I just got back, as it was a privacy transaction? I'm just curious about it. Okay.
When you say privacy transaction, are you talking about staking or DeFi? Because this sounds like a staking transaction. You're kind of transferring, for example, 100 Zcash coins, and you're getting 120 back. Is that what the question is? Because if that is the case, then 20 coins will be taxed as your taxable, ordinary revenue, as I say. But if this is a privacy transaction, you mean to say that you gave these coins to another individual to do things, whatever that person needs to do. This is something off the books kind of a process. Like, you're not involving a platform. This is something that you're doing. So you're selling the coin to someone else, they are doing another transaction, and you're receiving the coins again. So that is itself a taxable event here, because you're not just, it's another person. It's like transferring money to someone else. Like, for example, when you transfer more than $10,000 to someone else in the US, you need to justify why that transfer was made. So if you can justify it, saying that, okay, it was just made for to help them out, or to give it to them
Mhm.
to trade for me, then it's not taxable.
Okay, hope it makes sense. And yeah, like moving to another question from
Okay.
Smith, what crypto transactions are taxable?
As I already mentioned about taxable transactions before in the session, but when you sell a coin, that's a taxable event. When you receive airdrops, it's a taxable event. When you trade one coin for another, it's a taxable event. When you're receiving coins for business payments, and when you're dealing with that for your business, it's a taxable event for your business, and that'll be dual taxed. When you're receiving coins for your NFT sales, that's a taxable event. When you're receiving airdrops, it's a taxable event. Yeah, but to keep it basic, I think that's what Smith is trying to ask us here, is that coin to coin is a taxable event, and selling a coin is a taxable event. But if you're transferring coins from one wallet to the other, and both wallets are owned by you, then it's not a taxable event. It's like you're transferring money from one bank account to the other.
Okay, and moving to another question from Kiki, what's the
Okay.
tool or API that used for calculate tax from crypto, and if differences countries laws, how it's work?
There's no global crypto tax software that's available currently. But with time, I feel there will be a software that will help users, say that, okay, they are from this country and they need to integrate accordingly. But there's no one-stop place for this yet. And connecting APIs from exchanges and wallets is possible, but you need to be a little careful when you're using the software. Yeah, everything
All
is a
right.
taxable. That I see the comment at the bottom.
Mhm. Yeah, yeah. I have one questions. Like how how it decide that from the wallet that, okay, I'm the owner of this wallet. I haven't like, let's say I created a MetaMask account. Okay, I haven't give any information about my
Right.
identity. Yeah. So yeah, how it detected.
So basically, you have coins in your MetaMask. Okay.
Yeah.
Now you have those coins because you've purchased it from somewhere,
Yeah.
right? If you haven't purchased it, someone else has purchased it, because you
Yeah.
cannot get coins out of thin air,
Hmm.
right? So
Yeah.
whoever has purchased it, someone must have sent it to you. Now,
Mm-hmm.
little does everyone know, all platforms are reporting to their respective government agencies on a weekly basis. So every transaction that you're making as an investor with an exchange, that data has already gone to the government. So if you're, the US government recently released a new guideline that if you have transferred more than $10,000 to another wallet within 1 year, you might receive a tax notice, or you have to justify that transfer. So this has to also be implemented by other countries. Like for example, in India also, if you transfer more than 5 lakh rupees worth of coins, that has to be triggered under a tax audit, and that person would essentially be grilled down to a tax notice.
Okay, so another question: how many countries have their crypto tax laws right now?
There's not many countries that have these laws
Mm-hmm.
straightened out, to be honest. It is the US, firstly, I would say, because I've worked, in this industry and department since a few years. So I know that US has their guidelines and they're still improving them. But
Mm-hmm.
not many countries have it. Like Switzerland has, yes, they have a few guidelines. Tax-free countries like Dubai don't have guidelines because it's anyways tax-free. Australia has guidelines that are similar to the US, because I've worked with a few Australian clients in the past. So I kind of get an idea of where this would go in the coming future. But to answer your question, the US has set guidelines in a very sensible way, that they do understand what is a taxable event. If you've transferred coins to yourself, it's totally fine. But if you're trading one coin to the other, then you have to pay tax. They need their share. If you're making money, they want money as well. That's as simple as that.
All right, and we got some more questions. People
Okay.
are like so curious to know about crypto taxation. So another question from Smith: how does the IRS know you owe crypto taxes?
As I mentioned, I mean, Coinbase, Binance, all these exchanges that you guys are, like, everyone is trading on, they report to the IRS directly. So every time you do a transaction, a summary report has already gone there. So they do send reports based on your, purchases, cost basis. So the report that you export from the exchange, a copy has already gone to the IRS. So they know that you're trading. And if they feel that there are transfers made more than $10,000, they know that there is something else behind the scenes. To know more about it, you might get a tax notice. It's as simple as that. They don't want to use their head a lot. If they want to dig deeper, they'll just send you a notice and they want you to talk more. They don't want to talk.
All right, and moving to another question from Gautam Mehra. If
Okay.
I am planning to hold my coins for more than a year, should I be worried about taxes before selling them? By the way, receive great information on ICOs. Thanks. Yeah.
Thanks, Gautam, firstly. And if you're planning to hold these coins for more than a year, that's a sensible thing if you're trading in a country like the US, because US has long-term capital gains tax at 20% versus short-term at 20%. 40 to 20, my bad. So, but when a country like India, they have the short-term capital gain tax is lesser than the long-term
Mhm.
capital gain. So it totally depends on which country you're from, and what's your trading strategy. But holding it, if you're invested in the right coin, you believe in the company, what the company is doing. Cryptocurrency is not just about investing and you're going to increase your portfolio and you're going to make money. It's not just that. You're supporting good companies, do good work, and that's how you're going to get rewarded. That's how I look at it.
Okay. I just got one more question. Should we move to another country if the taxes are very high? Let's say in the US taxes are high, and Australia, I heard that 30% is tax for crypto taxes. Is that true?
That, that is true. I would, if I've made more than $1 million in cryptocurrencies, I would be sitting in a country like
Mhm.
Dubai today, because they don't have taxes, right? I'll just transfer
Yeah.
my coins there in a wallet over there. I'll just, buy some land or property and settle there for a year. It's just you have to be a tax resident of that country for over 6 months, and you're a resident, and you're not supposed to pay any taxes there. So that's a good idea. You can move to another country. There are other countries like there are other places that do not have taxes, so you can just do your research and move if your coin performs.
All right. I think I'm done with my questions. If anyone
Okay.
have any more questions, feel free to ask in Q&As. Then we can end this workshop. I hope you all enjoy this. All right. Let me check the chat. Okay. Another. Okay. Thank you. Taxable event. Can I choose to answer or not answer in questionnaire? Yes, of course. Why not? Okay. Some people are waiting for POAP. Yeah, you
Okay.
will receive you all will receive an email soon. Okay. Another message. Thanks. Okay, thank you so much. All right. If you all don't have any question, then we can just end this webinar. Thanks for the workshop, quite educative. Thank you. Thank you so much, Smith. Thanks, Anastasia. All right. Okay, and if you want more stuff like this, you can join our Discord server. And if you want to find how to join that, you can just type covalenthq.com/Discord, and you can just follow us on Twitter, and you will find the recording of this webinar on our YouTube channel. So yeah, thanks everyone for joining. Wonderful workshop. Great. Thanks. Thanks, Abhinav.
My pleasure.
Yeah. All right. See you soon.
Okay, bye bye.
Bye. Bye, everyone.